I'm Owen Bigland. This is the Inside Edge video blog. You can't help but feel for the people currently that have lost their jobs, they're out of work because of the COVID-19 pandemic here. Especially hard hit have been people in the hospitality business, the airline business, you know, restaurants, bars, hotels, a lot of small business owners that have been closed, no money coming in. It's a horrible situation. You know, you see, even starting just 1 or 2 weeks into this lockdown mode, we're seeing stories about people that had missed one paycheck and were already on the brink. And this is not surprising. I mean, this is something that a lot of people have known about for a long time. It's been at least 5 or 6 years that I've been seeing these articles coming out in BNN and the Financial Post and Globe and Mail and CNBC. You know, they had stories about if someone were to be hit with a $1,000 unexpected car repair, 50% of Canadians and Americans wouldn't be able to pay it, which is crazy. They're all, living paycheck to paycheck. So it doesn't surprise me that, when people miss a paycheck or two, the restaurant closes, they're in dire straits. Now, a lot of this, I've had many conversations with people over the years on my blog here talking about financial literacy. And one of the reasons why I wrote my book was to try and help people with some of the basics of saving their money, paying themselves first, saving for retirement. But I know it's tough when you're working paycheck to paycheck to get into a system like that. But a lot of this, in talking with some people on my YouTube blog here, I put on the schools, on the education system. Financial literacy, in my opinion, is something that should be taught starting in grade school, in grade 5 or 6, and should run all the way through high school. I put it in the same class as reading and writing and financial literacy. The basics. How to save your money, how to invest your money, paying yourself first, creating an emergency fund, the basics of stock investing, the difference between renting and owning a home, leverage, mortgages. It's all very basic stuff that you could start teaching people in grade 5 or 6. By the time they graduated high school, I think they would have a pretty good working knowledge of the basics of money. And I was thinking, I've done a couple of blogs on the FIRE movement and how there are certain things with the FIRE movement. The FIRE movement is financial independence, retire early. And it's been a huge, popular movement here over the last 5 or 6 years. I did a blog a couple years ago because I had done an interview with an American financial magazine asking me my thoughts on the FIRE movement. And there's a lot of things I like about the FIRE movement, but I also talked about in that blog a lot of things that I didn't like. The things that I do like about the FIRE movement are A, paying yourself first. And I talk about it in my book about at a young age, even working paper routes and working at the golf course, I was paying myself 15 to 20%. Pay yourself first, spend the rest later. And everybody should be trying to save at least 10 to 15%. The FIRE movement people, they will have you saving, some of them are saving 40, 50, 60, 70%, which I'll get to in a minute, I think is too much. And what I talked about on my blog a couple years ago, one of the things I don't like about the FIRE movement, I think some of them go a little bit overboard and they shrink themselves instead of expanding. I'll get to that in a minute though. But paying yourself first is critical, and getting an emergency fund. You should be setting aside 10 to 15%, even if it doesn't matter what your job is. If you're making $30,000 a year or $100,000 a year, you should be able to save 15 or even more percent of your paycheck. You get used to it. It's tough the first few paychecks, but I can tell you that after 6 months or a year, it becomes you become a creature of habit, and it becomes much easier to set aside that 15 or 20%. Everybody needs to have an emergency fund. An emergency fund, financial experts will tell you, anywhere from 3 to 6 months salary. 3 months minimum for unexpected emergencies that life is going to bring you. They're going to come up. Car repairs, medical expenses, you get laid off from your job, you get what's going on right now, the corona pandemic. you should have a 3 to 6 month emergency fund. Those funds should just be kept in a bank account, maybe a term deposit, a GIC, but nothing that's really locked in. Maybe a high interest savings account, because you need to have access to that money. You don't want to be putting that money into stocks or bonds or treasury bills or Canada savings bonds, because they're not redeemable. You're not going to earn any interest on it. You're actually going to lose money on your emergency fund every year with inflation, but that's not what it's meant to be there for. It's meant there to be for situations like what we've got going on now, where you're not working and you need 3 or 4 or 5 months worth of living expenses. So that's one thing that the FIRE movement gets right. Pay yourself first, and also they get right, live below your means. And that's how you pay yourself first. Especially when you're building up that emergency fund, which in some cases might take people 2 or 3 years of saving to get that 6 months worth of emergency funds. To do that, you've got to live below your means. I did this when I was growing up and when I was in my accumulating years. I lived way below my means. Doesn't mean you go out and buy or lease a new car. You drive the car you've got, or even better, you ride your bike and use car sharing. You're not going to the Canucks games. You're not going out for dinner that much. You want to enjoy some of these things. Go back and watch my blog I did a few years ago on the FIRE movement. But until you get that emergency fund built up, you've kind of got to live without some of those luxuries. Once you've got it, then for sure you want to have a bit of fun and enjoy your time. Wanted to just go through a couple of things with the FIRE movement here. They get it right by living below your means, having an emergency fund, paying yourself first. As I talked about a couple of years ago on that blog, the things that I don't like about the FIRE movement is I follow some of these guys with the FIRE movement, these stock investors, and they're saving 50–60% of their income, which is a lot, which is great. The problem is, though, a lot of them are in 9 to 5 jobs. They're making $30,000, $40,000, $50,000 a year. They're not making $200,000 a year. Most of them don't really enjoy their work. It's a job. It's not a career. They're not self-employed, which I've always recommended people try and do. You got to have a job and work for someone when you're starting out, but you should try and position yourself into more of a career, or even better, becoming self-employed, because that's where you're going to make the big bucks, when you're self-employed. But where they get it wrong, a lot of these FIRE guys, is they're in jobs 9 to 5. They don't like the job. They don't like their boss. They're making $40,000 a year and they're saving $20,000 of that, with the goal being that after 20 or 30 years, they can tell their boss to go shove it, and they're going to retire at 45 years old or 48 years old on an income of, I don't know, $25,000 or $30,000 a year. Now that might work if you're living in some Midwestern town or up north or something. But for most people, if they're living in a major city, you're going to need a lot more of that to live on. The point I'm making here is that these people, they shrink themselves and their ambition in order to save 40 or 50%. How I've always done it, and what I think most people will tell you with any experience, is for sure, pay yourself first. Set aside that money. Get an emergency fund. Live below your means, but at the same time, try and expand yourself. Get better at your career, or move up the corporate ladder if that's what you want to do. Get a side hustle. Start working on getting your own business started, or get into a sales job where the sky is the limit when it comes to income. The harder you work and the more time you put into it, the more you're going to move up the pay scale. That's when you really start cooking. Paying yourself first, living below your means, but expanding your income potential. Now you're cooking. Now you're going to go from 50 to 100,000 a year to 150 to 200 to whatever. And if you can still save 10 or 15% when you're earning 300 or 350K, now you're really cooking. You're going to be investing that money, putting it into stocks, buying real estate. By the time you get to into your late 40s or early 50s, yeah, you can retire now if you want, and you don't have to retire by living on pork and beans and not going anywhere, and your treat for the month is going to the movies. Now you can travel, you can drive a nice car, you can live in a nice house. Now you've kind of supercharged your retirement. But everybody's goals are different. For some people that might mean retiring on $50,000 a year. For others it might mean retiring on $150,000 a year. There's no right or wrong there. But with the FIRE movement, it's great. Pay yourself first. Get an emergency fund, live below your means. But again, supercharge it by not just sticking to a 9-to-5 job and shrinking yourself in. Look for ways to get better, to move up the corporate ladder, or to move up the pay scale, or to start your own business. That's what you want to be doing, and that's where a lot of people in the FIRE movement get it wrong. Just wanted to finish it off here with I was reflecting the other day on the weekend here. I got a little more time on my hands. I'm still staying pretty busy here, trying to stay productive with everything that's going on here, but my real estate business is slowed. I purposely slowed it right now. I want to wait and give it a little more time here until we get a better curve on this pandemic, and then we'll kick it back off again. But I was reflecting back on my 30-plus years as an investor and some of the things I've learned both as a real estate investor and as a stock investor, building up my stock portfolio. So I'll just share a few of the things, and some of these I've shared with you guys over the years, but hey, let's just refresh some of them. Some of the things I've learned is if you're going to stay in a city, whether that's Vancouver or Toronto or Los Angeles, you like the city, you're going to stay there, your number one priority should be to buy your principal residence. Hook or crook, you should be possessed by this. I can't express this strongly enough. Renting in a city like Vancouver long term is a recipe for disaster. You're going to be paying $2,200, $2,300, $2,400 a month for a basic one bedroom, and you're going to get nothing back for it. You are going to spend over the next 25 or 30 or 35 years, which is that's how long you're going to need a roof over your head, 50 years maybe, you're going to spend well in excess of $1 to $1.5 million renting a one bedroom and have nothing to show for it. The tough part, as I've always said, is getting the down payment. That is the biggest hurdle in life. That's the one thing I've learned that I've tried to impart on my viewers here. Live below your means, get an emergency fund started first, and then pump everything you can into getting the down payment funds to get into your first place. Because once you're bought and you're in, your holding cost to own versus renting are not going to be much different. And now you're paying down the principal and you're creating equity over the long term. You got it working for you both ways now. Other thing I've learned over the years, be careful of who you follow and who you take your advice from. When I was young and starting out and moving up in my career, I seeked out people that had success and had transparency. It's a lot tougher now because anyone with a camera now can run a blog or a Twitter site. The problem is that the vast majority of the ones I see on Twitter and YouTube have no clue what they're talking about. They have no transparency, they have no success, so why are you taking your advice from them? Seek out transparency, only get advice from people that have been there and done it. And there is, on the plus side of technology now, there's a lot of bozos out there that you're giving you bad advice, but at the plus side is there's a wealth of fantastic information that is out there. Incredible podcasts. You can get financial newsletters, websites on financials and real estate that are, I never had when I was in my 20s and 30s. But be careful who you listen to. Seek out people with transparency. Ignore predictions. A lot of people out there seem to have a crystal ball. I get it all the time on my YouTube blog here. They seem to know it all. They know exactly where the real estate market is going. They know exactly where the stock market is going. The world is falling apart. You're crazy to be buying real estate. You're crazy to be buying McDonald's shares. I've heard it all over and over again for 30 plus years as an investor. These guys that come out of the woodwork, they all think they know what they're talking about. Again, look for transparency. If you dig a little deeper, these people are living in their parents' basements. They have no success. They have no money. They're just mad at the world and they want to bring you down with them. So nobody knows where the real estate market is going to go in the short term, just like nobody knows where the stock market's going to go. We have had the wildest volatility I have ever seen, and we've got Wall Street guys that have been in the business for over 50 years, have never seen anything like we've gone through here, where we've had 3,000 point ups and downs on the Dow, 15%, which is unheard of because these are large cap blue chip stock. Nobody knows what it's going to do tomorrow. The Dow could drop 10,000 points in the next 2 weeks for all I know. I have no clue. But what I do know is that over 10, 15, 20 years as an investor, that's how long I'm going to be holding these companies. I know I'm going to collect a nice dividend every quarter from these companies, and I know I'm a believer in American and good Canadian corporations, and most of them will get through it. Some might not, but most of the ones I hold, I've done many blogs on it, I only buy the best of the best. I'm sleeping well at night, collecting my dividends. I know in 20 or 30 years, I'm going to be very pleased. I mean, my portfolio is up. I've been an investor for over 30 years. This has been a pretty sharp pullback of about 25, 35, between 25 and 35% so far. Could get worse. But I've lived through worse, and I've got holdings now like Apple and Eli Lilly and Johnson & Johnson that I'm up 3, 4, 5, 600% on. My Johnson & Johnson shares, I think I'm up over 1,000%. McDonald's, I'm probably up close to 700 or 800%. PepsiCo, which was one of my very first stocks I bought, I've held those shares for over 25 years. I don't even know what I'm up on those stocks because there's been stock splits and spin-offs. I would say I'm probably up 1,500%, including my dividends over the last 25 years on my Pepsi shares. So a little 25% correction here, not doing too much damage. That's why I'm going to stay the course. There's always going to be dark clouds out there. I tell people you're an investor, you're not a speculator. Buy your principal residence as opposed to renting. Hold it because you're going to need a roof over your head anyways. If you do need to sell, there's lots of good reasons to sell because you need a bigger place or you're downsizing, you need a smaller place. But keep it. Max out your RRSP and your TFSA by buying good quality US and Canadian companies that pay you a dividend and increase that dividend. Tune out the negative people. Tune out the predictors because they don't know what they're talking about. Stay the course, relax, let your money work for you. Enjoy your home if it's your principal residence. Down the road, if you want, buy an investment property. Once you've got your RRSP and your TFSAs maxed out and you bought your principal residence, then the next step would be to buy an investment property to get a little more diversification, take advantage of the leverage, take advantage of these 2% interest rates. Put a tenant in it and keep it for 20 or 25 years. You're going to do incredible. It's really a simple formula. It's really as simple as this, and this is what they should be teaching people starting in grade school. How simple this is. Don't get cute. Don't try and time markets. Don't try and day trade. You don't need to. I've told so many people here that my portfolio, my real estate portfolio, and my stock portfolio is 100% passive. Now, I enjoy doing a little bit of work and researching companies, but for the most part, it's passive. I don't have to do anything. I just collect the cash and take that cash and buy more shares that I've got on a watch list. Any research and reading about CEOs I do because I enjoy doing it, not because I have to. I could let my portfolio just run on autopilot and put the dividends on an automatic reinvestment program if I wanted to. My real estate portfolio isn't totally passive, but almost. Every couple of years, I got to run an ad and get a new tenant in there and run a credit check. And every now and again, I'll get a call from a tenant about something that might need to be repaired. But for the most part, I don't have to do too much. Instead, I enjoy my life. I enjoy my career as a realtor, so I focus on that, getting better at my career, serving my clients. As I've told people, every listing I put out there, I kind of treat as a personal vendetta to try and get them the top price. It's like a game for me. It's a sport. And I enjoy it. And then I enjoy staying in shape, working out, eating right, traveling, and everything else. I let my investments do their thing, make the money while I sleep. And that's the way you should look at it too. So many people are their own worst enemy. With all the data they've got now, they think they need to be doing something, trading in this and selling that and worrying about this and worrying about that. There's always something dark coming around the corner. I've learned from the past 30 years that you want to be aware of them, but don't let them control you. Don't let them influence you in any way. Just stick with the program. Keep it simple. That's all it is. And this kind of stuff, again, should be taught starting in grade 5 or 6. But unfortunately, people just don't take the time to learn the basics of this. And we're seeing this, unfortunately, on playing now with people that are, on the brink after missing 1 or 2 paychecks. We'll get through this current pandemic, and we do, folks, as I said many times before, let's support our local businesses. Go back out eating if you can, if you're in a position where you can. Support the local businesses, the restaurants, the bars, the airlines, the hotels, the hospitality, whatever, if you're in a position to. We'll get through it. You know, tough times don't last. Tough people do. I'm Owen Bigland. As always, see you next week.